Well, hello and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and today we're going to be talking about cost volume profit analysis, which is also known as break even. Breaking even is one of the most important concepts in business because we need to know how to generate this thing called a profit based off of the number of units I need to manufacture and sell to break even or make a profit. We always want to sell more than what it costs. And so let's talk about those concepts. And I'll give you a couple of examples, and I'll ask you guys, what your thoughts are, and for your businesses, and it'll be fun. Okay, so let's take a look at a couple of different cost concepts. We'll talk about sales volume, which is how many units we need to sell, and we'll talk about different points of break even. Also analyze that information. So the first thing I want to talk about is the cost behavior in relationship to the amount of units I need to sell. So in order for us to really understand cost, we need to understand how many units we need to sell in order to break even. Remember, the point of break even is where I'm selling the number of units at the total cost. How many units do I need to sell in order to generate enough revenue to cover all of my business's cost? We also need to look at how much income will increase by if we install additional machines to reduce labor costs. What kind of changes will I need to implement if my income's if selling prices decrease and my sales volume increases? All of these questions that we're looking at here really help us to understand how to set our prices, how to establish sales goals, things like that. It's all behavioral. It's all behavioral. So let's relax our minds and think about toward the very beginning of this course. So week one, this is the second chapter. Week one, we talked about fixed costs and variable costs. Hopefully, you all remember that conversation. But as you recall, let's first talk about the cost per unit. A cost per unit, the total cost of a unit is my direct materials plus my direct labor plus my factory overhead equals the total cost per unit. Okay? Direct material plus direct labor plus factory overhead, that's my total cost per unit. Now that we know total cost per unit, or remember total cost per unit, we also need to understand what my fixed costs are and my variable costs. Okay, so let's look at this. Variable costs are the cost per unit. Why are they variable? Because they change with the level of production. I have direct material, direct labor, factory overhead equals total cost per unit. Total cost per unit is variable cost. The more I sell each unit, the more units I sell, the more variable costs I have. My variable costs will continue to increase with each unit I sell. My total materials, direct labor, factory overhead, all of that increases with each unit that I sell because each unit costs me the total cost per unit. So that's why we say that the each unit sold represents the variable cost. So let's break it down. Variable costs increase with each unit sold. Fixed costs do not change. They are fixed. Fixed costs would be things like supervisor salaries. It would be things like um, depreciation for the building, rent, mortgage, things that do not change over time. That's what makes it a fixed cost. Fixed costs stay the same regardless of the level of output. My salaries don't go up because I'm selling more, they stay the same. So, fixed costs are the costs associated with the cost of the product that do not change over time. Variable costs increase with the more that I sell. So, looking at this first part of the slide on the top, this graph here, I have fixed costs and variable cost per unit. My total fixed costs plus cost per unit gives me my total cost, the total cost of my business. I got fixed costs plus variable costs. That equals total cost. Fixed plus variable equals total. And we know that the variable costs increase with the more sales per unit that I make. My fixed costs remain the same regardless of the level of output. Okay, so that's the top. The second relationship is slightly different. Here's why. If you think about how we manufacture, direct materials, direct labor, factory overhead, you would think that the more we produce, the higher our costs are. That's true to some degree. To some degree. Eventually, they level out. Our variable cost per unit actually stays the same because it's per unit. My direct labor, direct material, factory overhead for each individual product, each individual unit is the same. In this example, $20 per unit. If my direct labor is $10, my direct material is $5, and my factory overhead is $5, that's $20. So direct material, $5. Direct labor, $10. Factory overhead, $5. It's $20 per unit. And it's the same for each unit. So my variable costs remain the same. My fixed costs on a per unit basis decreases with the level of output. What do I mean by that? Let's take a look at the supervisor's salary. If I were to say my supervisor's salary is $32,000 and I tie that salary with the units of production, the fixed cost per unit will decrease with the more I'm producing. And the reason for that is if I produce 5 units, I have a high total fixed cost per unit per unit. If I have if I produce a lot, my total fixed cost per unit is going to be lower. And that makes sense because if I associate my fixed cost with the level of production, I'm associating it with each unit produced. Per unit. So that's how fixed costs operates. Fixed costs remains the same over time regardless of the level of output, but it can be associated with each unit produced. Variable costs, direct material, direct labor, factory overhead, the total increases with the total units produced. but on a per unit basis, it remains the same. The total cost per unit is $20. Direct material, direct labor, factory overhead. The total cost increases over time with the more I'm producing and selling. The variable cost per unit remains the same. Now, here's an important concept. We understand variable costs, we understand fixed costs, but what about mixed costs? Mixed costs. We talked about this briefly before. Remember when we talked about electricity as being a mixed cost? It's both fixed and variable, right? Why is that? Well, we have a base amount of electricity being billed each month, and we have an amount that's being consumed each month. The base amount, that's fixed. That doesn't change. It's the same every month. The variable amount changes every month. So that's therefore it is considered to be a mixed cost. It is both fixed and variable. That's the idea of a mixed cost. And the mixed costs increase over time with the amount being produced. It's the same concept, right? Fixed plus variable is mixed. We have a base amount plus a variable amount based off of the level of production. This one's a little different. We also have this process called stepwise costs. Stepwise. Uh, I've heard it called a couple of different terms. But if you look at this graph, it shows it as being steps. Yeah, up to a certain amount of production, it goes up. Certain amount of production, it goes up. Certain amount of production, it goes up. So like every 700 units of production, my cost will increase. Every 700 units of production, my cost will increase. It looks like a staircase, right? That's why they say it's a stepwise cost. Some companies use this to represent uh, basically like stages of activity, right? The cost will go up a little bit based off of each batch being produced. And I'll talk about batches as well. We also have this what we call a curve linear. That's nice. Cost, and this represents an increase in cost over time with the increased level of production. Based, but it's not a straight line. It doesn't just rise incrementally. It rises based off of each stage of production. That's curve linear. We're not going to dive too deep into curve linear. It's pretty complex, or even the step one. But all of this to kind of it shows you the relationship of cost and cost behavior. With the cost behavior, there's a couple of different graphs that we look at. And these graphs show us how we classify fixed and variable costs. So there's three methods. One's called a scatter diagram, second is called the HighLow Method, and third is called regression. You might remember some of this stuff from your statistics class. If you haven't taken statistics already, which I think you should have, but if you didn't, for whatever reason, something like this will come up in your statistics class. This is called a scatter diagram. The scatter diagram shows us the correlation relationship between fixed and variable costs over time, based off the level of production and the related cost. It's a way of estimating costs. And we can see that the line, the cost behavior line, is very close to each month of production's actual cost. It's an estimate. So we call this a baseline. It's a way of estimating costs. The second method is called the high-low method. High-low method is actually probably one of the easiest ones. We take the highest month and the lowest month. Okay, here's how it works. So here's some data. We got January through December. We take a look at the total cost associated with each month. So who can tell me which month has the lowest total cost? Just looking at this information, which month has the lowest total cost? What do you think?
June.
June. Yes, June.
June, my birthday month.
Your birthday month, June. Awesome. Yes, June is correct. Yeah, so June, we produced 17,500 units. Our total cost of production was 18,500. So June would be the low. Now, what about the highest month? Who can tell me what's the highest total cost for which month?
November.
November?
Hold on. Yeah, I ain't see.
Yeah, November, 31,000.
You're right. You're right.
Yeah, 31.
31,000.
Yeah.
November. Yep. So we got our high month, November, 31,000. We produced 67,500 units. That's our high. Our low, June, 17,500 units at 18,500 total cost. Now that we've found the high month and the low month, we can apply the high-low method. So there's two steps to this. Step one is we compute the variable cost per unit, and step two is we calculate we identify the total fixed cost. So November, the high month, 67,500 units, total cost 31,000. Low, June, 17,500 units, 18,500. We add the total, we take the high month minus the low month to get the total change in activity. The highest month, November, the lowest month, June. High minus low equals change in activity. High minus low equals change in activity. We take the change in the cost divided by the change in the units to get the total cost per unit. Okay, so 31,000 high minus 18,500 low, 12,500. So change in total cost, 12,500, divided by change in total units, 50,000, equals 25 cents per unit of variable cost. My total fixed cost in this example is 14,125. How did I get that amount? Let's look. I'm sorry. My total cost is 14,125. How did I get that amount? Our fixed cost plus our variable cost times number of units. Variable cost times number of variable cost 25 cents times number of units 67,500 at the high gives me 16,875. 16,875 plus fixed cost gets me total cost 31,000. Gets me down to here. Let's see. I got lost. 14,125 plus 25 cents per unit produced. So my total fixed my fixed cost is 14,125. How do we find it? We took our total cost minus our variable cost to find the fixed cost. It's just like working backward. Total cost minus variable cost equals fixed cost. Total cost minus variable cost equals fixed cost. So that means my total cost is 14,125 plus 25 cents for each unit produced. The third method is called regression. Regression. This is one of those uh, statistics terms, yeah? Regression. We're just going to talk about it real shortly. We use spreadsheet programs and calculators to find what we call a regression line. The regression line is essentially kind of like what we call a spatter graph. And it shows us the total fixed costs and variable costs on lines, yeah? So and we're not going to dive too deep into regression analysis. This is not an advanced statistics finance course, but we're just going to briefly talk about it. So, what most companies do is they'll compute the methods to find which is the most effective for their company. We can see that the HighLow method had a fixed cost 14,125, variable cost per unit 25 cents. The regression method had 16,668 fixed cost and a 20 cent per unit cost of variable cost. So now that we have an understanding of cost behavior, we can begin the process of identifying how much we need to sell our products for in order to break even, and to also figure out how much profit per unit we can get. So the best way to figure out the profit per unit is quite simple. We take the sales price, how much we're selling it for per unit, minus the total variable cost per unit. Sales price minus the total variable cost per unit. That gets me this thing called a contribution margin per unit. Think of the word contribution margin as profit. That's my profit per unit. My contribution margin per unit. I'm contributing that amount to the company per unit to help me toward breaking even. I'll show you how that looks. So here we have an example. I don't know what product this is, but we sell this product for $100 a unit. That's our sales price. Our variable cost per unit is $70 per unit. So 100 sales price minus 70 variable cost equals a $30 contribution margin per unit. Okay. Now that we have our contribution margin per unit, we can calculate what we call a contribution margin ratio. This ratio tells us the average profit per unit expressed as a percentage. So we take contribution margin per unit, $30, divided by sales price, 100. 30 divided by 100 is 30%. Now, here we go. The meat and potatoes of this discussion, the break-even point. The break-even point tells me how many units I need to sell in order to break even. It's where our total sales equal our total cost. Total sales meaning number of units sold times the sales price to equal our total cost. Total cost meaning fixed plus variable cost. This is the point where the company neither earns a profit or incurs a loss. It's where your total revenue minus expenses equals zero. When it equals zero, that's break even. Revenue minus expenses equals zero, that's break even. So zero is break even point. You're not earning a profit or you're not losing money. That's break even. We express this in both unit sales and sales dollars. There are three methods that we use primarily to compute break even point: the formula method, contribution margin method, and the cost volume profit chart. If I want to find the number of units I need to sell in order to break even, I take my total fixed cost divided by my contribution margin per unit. In this example, my total fixed costs are $24,000. My contribution margin per unit is $30. That means I need to sell 800 units per month in order to break even. Isn't that nice? I like that. Tells me exactly how many units I need to sell to break even. I can also compute the break even in sales dollars. I take my total fixed cost divided by my contribution margin ratio. Fixed cost 24,000. Contribution margin ratio 30% or 0.3. 24,000 divided by 0.3 is 8. I need to sell $80,000 per month of revenue in order to break even. Very important concept, breaking even. If you don't break even, you might lose money. You don't want to lose money, so you got to figure out what's your break even point. Fixed cost divided by contribution margin per unit, or fixed cost divided by contribution margin ratio. You'll get your break even for both units and dollars through those computations. It's a lovely concept.
Professor,
Yes, Lynette.
for a service company, for you to break even, it will have to be, you have to make as many sales as your overhead
Yeah,
cost
so
that month.
yeah, total
Okay.
fixed costs. Yeah, absolutely. Yep. Yeah, total fixed costs. That's right. Excellent. Another method of computing break even is what we call the contribution margin income method. In this method, we take our sales, total sales, minus total variable costs equals contribution margin minus your fixed costs equals your total income. Think of it like your income statement. Sales minus cost of goods sold equals gross profit minus your expenses equals net income. Follows the same exact process. Sales minus variable costs, which are, guess what, your cost of goods sold, equals contribution margin minus fixed costs equals net income. It works the same exact way. Very straightforward. The contribution margin using the income statement is probably the easiest. Total sales minus variable costs equals gross margin or contribution margin minus fixed costs equals net income. I like that one the best. It's just really straightforward, really easy. And of course, we can chart it out using the cost volume profit chart graph approach. It's not as practical. In my opinion, I think the contribution margin using the income statement's the easiest. But really, it's best to use the break even using sales dollars or units approach, because that really tells you exactly how many units you need to sell to break even. You can do the same thing with a chart. It's just, are you really going to draw out this chart? I mean, probably not, but we can see that the, we got our lines. We got total cost, total sales. Total sales minus total cost will give you your profit area. Our break even, as we said earlier, is we need to sell 800 units or $80,000 a month in sales to break even. Anything below that is a loss. Call it the loss area for the obvious reason. Another method is through the change in estimates. The change in estimates is relatively straightforward as well. We take our fixed cost divided by our um, what am I looking at here? I'm sorry, our fixed cost divided by our uh, what am I trying to say? The sorry, divided by the fixed cost divided by the variable cost per unit gives me number of units I need to sell. This is a revised break-even point. Because what happens when there's changes, right? If there's a change in your sales price, let's say your sales price goes down, okay? Or you put it on sale, or your sale price goes down. Then, of course, that means that you need to sell more units to break even. Lower the sale price, the higher the number of units you need to sell to break even. The higher the sale price, the less number of units you need to sell to break even. Because remember, it's sales minus your variable cost equals your contribution margin. If your contribution margin goes down, that means you need to sell more to break even. If your contribution goes up, you can sell a little bit less and still break even. So sale price goes up, you can sell less and break even. If your sales price goes down, you need to sell more to break even. That's what this tells us. Change in estimates. The cool thing about this uh, concept of contribution margin is, or break even, is we can apply break even in a couple of different ways. I showed you how we did it with sales dollars and with the number of units we need to sell to break even. That's the easiest method. But there's a couple of different methods that we can use. This next method is called the margin of safety. The margin of safety, it's a nice term, right? Margin of safety. It means exactly that. How many units do I need to sell to be safe, right? Safe as and not lose money. How many? That's why I call it margin of safety. It's our and this a lot of this is forecasts, right? How much do I need to sell in order to be safe? So we estimate our sales, how much we expect to sell. In this example, we expect to sell $100,000 minus our break-even sales of 80,000. Remember, I need to sell 80,000 a month to break even. So expected sales minus break-even sales dollars divided by my expected sales. That gets me 20%. 20,000 divided by 100,000 is 20%. 20% is my margin of safety. Think of it like a cushion. I want to sell 20% above my break even to feel safe. Margin of safety. And that's a nice one too. Uh, you can also think of it as like a target, and we'll talk about targets. But targets are like goals. My sales goal. I'd like to sell this amount in order to make this much profit. We'll talk about that. So sales minus variable costs equals your contribution margin. Minus your fixed cost equals your net income. So take a look at this. Our sales, 150,000. Variable costs, 105,000. Sales minus variable costs equals contribution margin, 45,000. Minus my fixed cost of 24,000 gives me an income of 21,000. Sales minus variable costs equals contribution margin. Minus fixed costs equals pre-tax income or income. Minus your income taxes equals net income. This is where I come with target income. This is a nice concept because it shows us, like, think of it this way. I really want to make $12,000 a month. How much, net income? I really want to make net income $12,000 a month. How do I do that? How much do I need to sell in order to hit that goal? This was the formula we would use. We would take our fixed costs plus the target income. Okay, that's how much I want to have net income at the end of each month, $12,000. Fixed costs plus target income divided by your contribution margin ratio, 30%. So 24,000 fixed costs plus $12,000 target income divided by contribution margin ratio, 30%, equals 120,000. I need to sell $120,000 a month in order to generate $12,000 a month of net income. That's what target income tells us. It's a really nice concept. So that's sales dollars. How many units do I need to sell in order to make that $12,000 a month net income? Fixed costs plus target income divided by contribution margin per unit tells me the number of units I need to sell in order to make $12,000 per month of net income. 24,000 plus the 12,000 divided by $30 contribution margin per unit equals 1,200 units per month that I need to sell in order to generate $12,000 a month in net income. That's a nice formula because you can plug pretty much any number that you want to make in your target income. It's like, all right, I really want to make this much per month. How do I do that? Fixed cost plus the target divided by the contribution margin to get your sales dollars or units that you need to sell per month to get that amount. That's why it's a nice formula. Really, it's very nice. And this is what it looks visually. Sales minus variable cost equals contribution margin minus fixed cost equals your target income. It's pretty nice. I like it. And as your costs change, you must also revise your point of break even. That makes sense. If my fixed costs go up next year or next month, as my fixed costs or variable costs change, I need to revise the point of break even. So you would take your new break even cost, in this case fixed cost, $30,000 is my new fixed cost, divided by my new contribution margin ratio, 40%, gives me my new dollar amount in break even. So the point here is that if your fixed costs and or your variable costs change, you need to then revise your break even in dollars and in units. A lot of companies sell more than just one product. I know that's not surprising. But as companies sell a lot of products, they need to compute the break-even point. You can compute the break-even point for the whole company. And we do that by looking at the sales mix. The sales mix, hopefully you remember this term from your intro to business class, but the sales mix is the variable products that you sell in your business. It's the combination of all the different products that you're selling. That's your sales mix. Yeah. We still need to find a point of break even if we sell a lot of different products. We do that by finding the break even point through cost volume profit analysis. We look at the unit contribution margin and replace it with the contribution margin for a composite unit, an individual unit, or a number of different products, I should say, sorry, which represents the sales mix. So to find this, we take the fixed cost divided by the contribution margin for all units. For all units, or what we call composite unit. Composite unit is a combination of all the different products that you're selling. So it's contribution margin for all the different units that you're selling, added together. So here's an example of this. And this example is like a cosmetologist. They provide haircut services. You get a basic haircut, an ultra haircut, a budget haircut. I'm on the budget side, by the way. Okay, so this company offers 3 different types of haircuts: budget, basic, and ultra. The ultra, oh yeah, that's the nice stuff. They give you the good product. The basic, yeah, it's the middle of the road. And the budget, that's for me. So you have your sales price, your variable cost for each haircut, and your contribution margin for each type of haircut. And then you have what we call a sales mix ratio. The sales mix ratio is basically the amount of sales I have for each type of haircut. So in this example, most people are getting the basic, a few are getting the ultra, and very few are getting the budget. So here's some data. We have annual fixed costs of $192,000. That's my fixed cost for the year. Let's compute the break even. So I got sales price minus variable costs equals contribution margin, and then I have my sales mix ratio. Sales price minus sales mix ratio, times the sales mix ratio gets me my total sales per type of haircut. My total sales price for the whole sale for the whole company, 160. I add my basic plus my ultra plus my budget, get the 160. Then I find my variable cost for the whole company for each different type of haircut I'm offering, $96. So your sales price composite, adding it across all different types, minus variable cost composite, adding across all different types, equals my contribution margin composite for all different types. Think when you hear composite, it's all the different types of products that you're selling added together. And for a lot of different products, we can find our break-even point for all of our products. I need to sell 3,000 haircuts per year in order to break even. Fixed cost divided by variable cost for all of my different products together gives me the total number of haircuts I need to make in order to break even. We're almost done. So I got my break even. I multiply that by my sales mix to get my number of haircuts I need to have for each different type of haircut in order to break even. And of course, the break-even point is my contribution margin minus my total fixed costs. It's when I equal 0, that means I've broken even. Contribution margin total minus fixed costs. If it equals 0, I've broken even. The thing with cost volume profit analysis is that we can classify costs as either being fixed or variable. It's linear in a relationship within a relevant range. All units are produced and sold, and the sales mix is constant. These are the assumptions that are associated with cost volume profit analysis. And of course, there's always going to be changes in our sales amount. And we can compute what we call operating leverage. Now, operating leverage shows us to what extent our fixed costs are being used in the organization. And we take our total contribution margin in sales dollars divided by our pre-tax income to give me my degree of operating leverage. It's not as used very much, but it's good to know. My operating leverage, or my total operating leverage, to find that, we take the contribution margin in sales dollars divided by the pre-tax income to get the level of leverage. In this case, 3 or 30%. If we take the operating leverage times a percent change in sales to get me my change in total income. This isn't the only way to find change in total income. There's a lot of different ways to do it. And this is the regression thing I was telling you about earlier, using all the data in a spreadsheet. Don't worry too much about this. We're not going to do that in this course. But this is called the least squares regression method. For those of you who remember something like that from your statistics course. And you remember that what we talked about, this thing called absorption cost, variable cost, fixed cost, absorption cost. This is kind of a recap of what we were talking about with respect to the contribution margin. That'll lead us into the next chapter. But my friends, that is the conclusion of our chapter 21 on our discussion of break even. Any questions at all on break even? And any questions?
Professor,
Yes,
so at
please,
the
go ahead.
break-even point, I think that's actually good for like when you start in a business, right?
Yes, yeah,
Yeah.
absolutely. So for those of you who are starting a business, you're thinking about starting a business. Identifying your break-even point should be the first thing you should do, because what that'll do is it'll also help you to set your sales prices as well.
Yeah.
Yeah,
Because
absolutely.
at the beginning of a business, you don't expect to make profit just like that, right?
Exactly. That's
Yeah.
right. And yeah, most businesses don't start out making a profit. So that's why it's really important to understand your break-even point.
Yeah, that's
Yeah.
true.
Nice comments.
Mhm.
Absolutely.
Thank you.
Are there any other comments, questions, or concerns?
Professor, one more thing.
Yeah.
Do you teach business statistics? Because I'm supposed to take that course next semester.
Once in a while I do, but not next semester.
Mm.
Next semester I'm only teaching principles 1 and 2.
Oh, okay. All right.
I specialize in accounting, so they try to keep me in that area.
Oh, right.
Yeah.
Okay. Thank you. Have a good one.
You too.
Bye,
And
everyone.
yep, and just to kind of recap,
Yeah.
everyone, make sure that you complete chapter 20 quiz, chapter 21 homework. Next week is your midterm exam. Midterm exam will cover the beginning of this course, chapter 17 through chapter 21. And we'll talk more about that when we get closer. But thank you all so very much for your time today. I really appreciate it. If you have any comments, questions, or concerns, please feel free to email me, call me, set up office hours. And always, please stay safe, wash your hands, do the right things, and I'll see you all again next time.
Professor, one more thing before you
Yep,
go.
please.
About the midterm. You said
Yes,
from 17 to 21, what we just covered
that's
today.
correct. Yep,
Okay.
it's 17 through 21. And
So that means yeah.
go
So
ahead.
that means we don't have class next week.
That-
The only thing we have to do is the exam, right?
That's correct.
Okay.
Yeah, great.
All right. Thank you.
Thank you. Have a great day. Thank you so much. Take care. Bye-bye.